What if I told you London wants crypto? The government is building its own digital pound. Banks are investing billions into blockchain. But here's the twist. They still don't trust Bitcoin. So the real question is London embracing crypto or trying to control it? From centuries-old banking dynasties to modern hedge funds, this city doesn't follow money trends. It creates them. But something strange is happening. Behind closed doors at the Bank of England, policymakers are working on a digital pound. At the same time, regulators are tightening rules around exchanges. And banks, they're quietly building blockchain systems, while publicly warning customers about the risks of crypto. So what's really going on? Part 1. The digital pound. Control or innovation. The UK government calls it innovation. A central bank digital currency, CBDC, modernizing payments. But critics call it something else. Surveillance money. A digital pound would be issued and controlled by the Bank of England. Every transaction recorded. Every transfer traceable. Now compare that with Bitcoin. No central authority. No single point of control. And that's exactly the problem. Because from a government perspective, decentralized money means less power. If millions of people move their wealth into Bitcoin, banks lose deposits. Governments lose influence over monetary policy. And capital becomes harder to control. So yes, London wants digital currency, but only the kind it can manage. Part 2. Regulation, fear. You're in the UK. You've probably seen it. Crypto ads restricted. Stricter exchange rules. Banks blocking certain crypto transactions. The Financial Conduct Authority has introduced aggressive compliance requirements. Officially, it's about consumer protection. Unofficially, it's about slowing uncontrolled growth because crypto moves fast. Faster than regulation. Faster than legacy systems. And London is built on legacy finance. The city generates billions from traditional banking, forex trading, asset management, and derivatives. If decentralized finance replaces even 10% of that, that's billions redirected away from institutions. But to shape it, to filter it, to make sure it fits inside the existing system. Part 3. Banks versus Bitcoin. Here. The contradiction nobody talks about. Major UK banks criticize Bitcoin publicly, but internally, they're investing in blockchain infrastructure. They love the technology. They just don't love the decentralization. Because blockchain without Bitcoin means efficiency without losing control. That's the key difference. Bitcoin represents financial sovereignty. Blockchain represents operational efficiency. Banks want faster settlements, cheaper cross-border payments, automated compliance systems. What they don't want is a world where customers don't need them anymore. And that's what Bitcoin threatens. For the first time in modern history, individuals can store wealth outside the banking system, transfer money globally without permission, protect savings from currency debasement that's revolutionary. And revolutions make financial capitals nervous. Part 4. The political angle post-Brexit. London is fighting to maintain its status as a global financial hub. New York, Singapore, Dubai, they're all competing aggressively in crypto innovation. If London ignores crypto completely, it risks losing relevance. But if it embraces decentralized crypto fully, it risks destabilizing its traditional financial ecosystem. So, what's the strategy? A controlled embrace. Support innovation. Promote fintech startups. Develop a CBDC. But regulate decentralized crypto tightly. In other words, keep innovation inside the walls. Part 5. The trust problem. Here's where it gets psychological. Governments don't trust crypto because they can't control it. But crypto users don't trust governments because they control too much. It's a trust gap. Bitcoin was born after the 2008 financial crisis, when banks collapsed and taxpayers paid the price. That memory still exists, and London was one of the epicenters of that crisis. So when policymakers push for a digital pound, many crypto advocates see it as the opposite of freedom. More visibility, more control. Imagine a future where money could be restricted based on policy decisions. That's not confirmed. But the possibility alone creates resistance. Part 6. What this means for investors if you're targeting UK or European audiences. This tension creates opportunity because markets move on uncertainty. If regulation tightens, volatility rises. If the digital pound launches, adoption narratives shift. If Bitcoin gains institutional backing, legitimacy increases. London's hesitation isn't weakness. It's strategy. And smart investors watch strategy closely. The real power move isn't choosing sides. It's understanding both systems. Centralized digital currency will likely exist. Decentralized crypto will likely continue growing. The future may not be crypto versus banks. It might be crypto inside a regulated framework. But the balance of power, that's still being negotiated. Outro power, CLO. So here's the real story. London doesn't hate crypto. It fears losing control. It wants the innovation. It wants the efficiency. It wants the global competitiveness. But it doesn't want financial power shifting away from institutions. And that's the battle quietly unfolding behind policy papers and regulatory announcements. The question isn't, will London adopt crypto? The question is, will crypto adapt to London? Or will London eventually adapt to crypto? Because one thing is certain, Money is going digital. The only uncertainty is who controls it. Please subscribe for finance ideas.